Hello everyone. So welcome to a new YouTube video on the Fed rate curve. And it's actually, as of September 2024, it's a hot topic for almost all the chief economics and the financial analysts around the world. And I hope my screen is visible with all of you. To begin with, like what actually has happened with this rate cut. So guys, actually on you must be all well aware that on 18th of September 2024, the FOMC meeting in USA actually announced that it would cut its target range by half a percentage point to 4.75 to 5%. Earlier, this range was actually between the range of 5.25 percentage point to 5.5. Now, this range has changed somewhere to 4.75 percentage point to 5 percentage point. So this is actually known as the FFR range, guys. And what exactly this FFR range stands for? This is the Fed fund rate. And guys, this was almost after 4 years that without any rate cut, that this post-pandemic period has elapsed. And now, in order to fight this inflation and all the like recession scenarios and all the employment statistics, which we are all seeing in a daily scenario, the FOMC meeting has to come across with such a like what I would say. A well on time decision, although it's too late. At least it was expected 1 quarter before, but yeah, like we can say, at least they have at least come to this situation. They are not too late, we can say. But yeah, see guys, what's the main purpose of all of this what I would say monetary policy decisions? So whenever any country does this rate cut, their ultimate motive is to actually inject more money, or what I would say more money supply in the economy in terms of cheap loans. And with this cheap loan, the inflation targets are actually controlled by the central bank of a respective country. So in USA, like what I would see, the major purpose for all of them is to bolster their economic policies, because for almost 2 quarters, the economy, since the GDP ratios and all the GDP to growth ratios have declined, so it's all of a recession scenario that US has officially entered. So they are mostly to bolster the economy, and in order to prevent a rise in their unemployment. Uh, the unemployment is a major focus area for FOMC meeting these days. So the unemployment ratios and all of those stuffs they are actually focusing. But in order to ask you guys, are you first of all, are you well aware, like, is this FFR is directly or indirectly affecting you? See, the question over here is that the FFR is actually the rate at which the two banks, the interbank borrowing and lending rate affects, and it's taken place on an overnight basis. But this is not the rate which actually affects all the consumer persons. It's the prime lending rate, which have its effect from this FFR rate, which we can say, which ultimately have their effect on all the consumers. So whenever the FFR rate, actually the FFR rate is somewhere in the range. They never say the exact range. The point estimate is never there, but the range estimate is always there. So the FFR rate, earlier it was in the if I'm not wrong, it was in the month of June 2023 that they had revised their rate. And now in the month of September 2024, now they have like altogether reduced their rates by 50 basis point. So the earlier range was this, and now the new range is this. So between this range, the rate cut is there, and now the focus area is there. Like from this FFR rate cut, our prime lending rates would be derived. And with this prime lending rate, all the mortgage loans, the housing mortgage loans, which we can say the housing loans, HLs, or the credit card bills, or any business loan, all of them would be having indirectly or what I would say a distant relationship with this Fed rate cut. So all in all, we can say that yes, it's a motive attack by the FOMC meeting in order to push the real economic growth. The purpose is to push the real economic growth for USA, which has what I would say officially entered into a scenario of recession, uh, vis-a-vis the past 2 quarters, which we are having a declining GDP to growth ratio. Now, guys, this is the chart like which I have taken a snapshot from the Federal Reserve of New York. So in this, you can like see what all are the different rate at different time scenarios. So as of today, the on Monday, September 23rd, 2024, the target range was standing at 4.75 to 5 basis point, and this is the effective Fed fund ratio, and the volume is 94. So this is how the rates were determined. Now, to have you a brief gist, like what is this FFR, the highly weighted, the hot topic, the all the financial gimmicks are all over the people around the globe are talking about this. So what exactly is this FFR? So to begin with, guys, the FFR is actually the rate, the target interest rate, which is set by the FOMC. The FOMC stands for Federal Open Market Committee, and this FOMC actually sets and focuses on this target FFR rate 8 times a year. So actually, they meet 8 times a year based on the prevailing economic conditions, and this FFR rate is nothing but the rate at which the overnight buying, borrowing, or lending is happening, and this is done from out of the excess reserve. So excess reserve, let's say it's with Morgan Stanley, and let's say any US bank, you name it, like let's say Bank of America. So Bank of America is need of some X amount of money. In an overnight basis, it may approach Morgan Stanley, and Morgan Stanley, from out of its excess reserve, will lend that amount of money to Bank of America. So the amount, what I would say, the which is lent, must be given at some rate. So that lending rate for Morgan Stanley and the borrowing rate for Bank of America must be decided with the help of this FFR rate. So this is how the FFR rate is determined on a daily business scenario, what I would say. Now, what happens, guys? By law, the bank must maintain a reserve equal to certain percentage of the deposit, and this is known as the reserve requirement. And out of this reserve requirement only, the borrowing and lending activities takes place between the different banks. And all of these, the like FOMC decisions have a far reaching economic consequences. So I have highlighted one formula over here. It's nothing but the probability. The P stands for probability. So probability of a rate hike or a rate decline by the FOMC meeting in the upcoming what I would say FOMC meeting. This is how it's derived. So market actually this time had already capitalized the effect of 25 basis point rate cut, but this 50 basis rate cut was more of a what I would say aggressive instance of rate cut by FOMC meeting. Reason being, they had already missed the last quarter rate cut, so it's all of a 25, 25 back to back two rate cuts they have aggressively captured. So this is how the formula for capitalizing, like what's the probability of upcoming Fed rate or Fed hike, it's there. So this is the formula, guys, actually how these things work. So here we take actually the implied for Fed forward rate by the future contract minus the current Fed fund rate, and it's divided by the Fed fund rate, assuming this is known as the expected FFR rate, guys. And out of this expected FFR rate, we deduct the current Fed fund rate. And all in all, if we place some values, like the respective values in respective quarters, which we are like having our financial analysis, the probability of a rate hike or a rate, what I say, decline comes, and it's usually quoted in terms of 25 basis point, guys. And in the multiples of that, let's say two multiples, it's like 50 basis point, and it might be like 3 times or 4 times as the case may be. So to go ahead, guys, this is like one like source which I have like taken from Investopedia. It's actually showing like in the year September 2024, the recent scenario, the Fed cut the FFR rate by 50 basis point, and it was almost a 23-year high since July 23. And the main purpose, guys, you can see, like first of all, in the COVID times, it was almost close to zero, like at the start of pandemic, and it remained there for 2 years. And then the rapid phase of the rate increase by FOMC meeting kept on going for a good amount of time, like till July 2023. And then when it came on a hold for more than a year, and the year like September 2024, we saw a rate cut of 50 basis point. So this is where we are standing as of today, and there is a high chance that the rate cut phase will be continuing for more than a 6 to 8 coming months. And what I would say, it can even continue for more than a year also, depending on the situation of inflation and what I would say the unemployment scenarios. Now guys, like the FFR is actually controlled by the FOMC meeting, or the Central Bank of USA, which we can say. And that there are the three possible scenarios. This is how they actually calculate and regulate the monetary policy of USA. So whenever we have a lower rate, so lower Fed rate decreasing the FFR actually leads to more money or money influx in the economy, and there is a cheap loans going on with the help of the banks. And with this banks, the banks are actually having a low reserve requirement, and in turn they are giving a more amount of loans to the ultimate consumers, and the consumers are investing or buying or even spending as per their more needs, and the inflation keeps on rising in the economy. But yeah, it's again controlled as per the directions of the what I would say the central bank. And whenever we see the FFR is increased, so there is all of a sucking of the money out of the economy, and the money is almost like the what I would say sucked out, or there is a outflux of the economy, outflux of the money from the economy. And there is a what I would say costlier loans available in the economy, because banks in turn are actually getting loans at their costlier rate from the bank to, let's say Bank of America is getting at a costly rate from Morgan Stanley. So in turn they are ultimately lending to consumers at a very high rate. So all in all, the demand actually decreases. Here the demand is actually increased, it's pushed to the demand, but here the demand is actually decreased. And all in all, it's a scenario like you might be there might be a decrease in inflation, or there might be a situation of recession, or which is might be coming in the near future. And there is also like the steady what I would say FFR rate, which we observed between the period of July 2023 till September 2024. So this is how, like I have highlighted, there was a scenario, guys, like during the time of Great Recession, that this FFR rate was slashed to a record low target of 0 to 2.5% in order to increase growth. And while for the raising the rate scenario, it was set as high as 25%. It see guys, it is a very high, whooping high rate of 20 percentage in the year like the early 90s, in order to have a response to the inflation targets by the FOMC meeting. And this whole study I told you between the time period of July 2023 till September 2024, and it's almost a time period of economic stability, or we can say the market is in sideways during that time. Okay, so these are the visible scenarios which I like took from the past. Like what happened in March 2020, the target rate was set between 0% and 0.25%. And the year in 2022, in order to combat inflation, the F rates its rate slowly, but it was a process continued till 2024. And the FOMC meetings increased the target FFR rate of it's actually a range I told you in the beginning, from like 5.25 to 5.5 in July 2023, and it was stagnant till date. Now, they had cited this reason while reducing the 50 basis point rate cut, that the progress on inflation and the balance of rates, it's ultimately a target of inflation plus economic targets plus unemployment scenarios that they are fighting. And it's almost a double-edged sword that we have to see in the coming years. So, guys, see, whenever we say the FFR rate is reduced, it never directly influences the consumers. We as consumers are never directly affected. The consumers, they have their borrowings, let's say in terms of credit cards, they have this housing loans, they have this business loans. They are never have a direct relation with this FFR. But what this FFR affects, they actually affects this prime lending rate. And out of this prime lending rate, the consumers are actually having their decision of their like whether the rate of interest it's costly or it's cheaper for them to borrow from the bank, because this FFR is actually interbank, a two banks borrowing and what I would say lending rate. But this prime lending rate, it's the rate actually with which the banks are giving it to consumers. So although it's not a direct relation, but yes, it's have its major say derived from this FFR. So this is how the indirect relation keeps on going. So guys, the rate I've just it down over here. The prime prime rate is the rate banks charge their most creditworthy borrowers, a rate that is influenced by the Fed fund rate. And this I've told you this over here. Like everything from home loans, auto loans, credit card, all have their decision derived from this PLR, and PLR derives a decision from FFR. Now, these are the basic sectors which were affected by the Fed fund rate. See, they like from the consumer cards, or what I would say credit cards, or all the consumer loans, there is a decision of this car loans, whether to take it or not. It's getting have a major say or decisive factor. So out of this car loan, this automotive industry is actually altogether directly affected. Out of this, the banking, banking, I can say, the borrowing loans from the bank, or we can say the ninja loans. The ninja loans were the loans which were actually given at the time of the 2008 crisis without even checking the credit worthiness of the ultimate customer. So these were actually given on the basic documentation, and yeah, the customer can have its loan. So these are known as the quick loans. Whether these would be given or not, it's again a decision of this FFR. Now, the other sectors affected by FFR were the consumer lending, the corporate investments, the foreign exchange. Like if any country like whose foreign exchange currency is more of a stable, will again derive a more inflow of the FFIs out of the like other HNI investors around the world. Like now, to go ahead, the government finance, the like whether they will be having this some T bills, or whether we will be having any corporate what I would say securities in order to invest them or not, whether they would be AAA rated bonds and not, so and so forth. The things keeps on going. So this is how that is influenced. Now, the real estate segment, although the housing loans have their decision derived from PLR, and PLR derived from this FFR. So yeah, we can safely say that we have a major decision on the real estate sector derived by FFR rate also. And the financial market, yes, the change in FFR rate actually have its decision. I show you by a formula of the probability, the P formula, and this is how the investors actually derive their decision whether to invest in this and or not, and how to capitalize the Fed rate hike or cut as per the decision factors of the FOMC meeting. Now, guys, this is the Bloomberg screenshot, like which I'm showing you on front of the screen. Actually, here we can see it somewhere close to here. We are standing in the year 2024. Like we are seeing the 2 to 10 year yield curve steepening, guys. The yield curve is actually steepening, and it somewhere stands at 7.2 basis point. And this is how like the picture is actually having a revolving nature. Like it's altogether a flip flop of the scenario, which we can see it over here. The yield curve is somewhat steepened at the current scenario 2024. Now, to guys, like what's to see in the coming days, which we can have a safe assumption from out of this, like whether the housing inflation would be increase or decrease. As of now, like the current statistics which I have seen as of today, it's somewhere standing at 6%, guys. And there is a high chance, like with the more influx coming after the rate cut, we can even see a huge spike in demand of houses, and the rentals might even spike out to a new high, and the housing inflation might be going way ahead than this target. But yeah, it's what we have to see in the coming days or coming months, like depending on the Fed policies also, and what how the consumer market, especially the housing loan borrowers, react to this. And once again, the unemployment statistics, see, for what I would say 2 good quarters, we have seen that the unemployment rates are actually rising in US, and which is altogether an alarming scenario. So, in order to bump out of this alarming signals, the unemployment statistics, until and unless they are like what I would say some unemployment insurance, or what I would say unemployment payments given by the Fed government, this is a visible target to see in the upcoming months and in the upcoming years also. Reason being, the company, what I would say a country, in order to derive out of its recession phase, it have to generate more and more employment generating activities, and this is how the situation is controlled out of a country in order to go into recession, and in order to pull it out of a recession scenario. So these two are what I would say a key focus areas. But for we as India, we can see a good scenario, like the FFIs as of today. The FFIs are more and more like interested in like investing in India, and although it's a festive season in India, we can see it's a good signal for what I would say the FFI investing in India, and also the market like having a huge spike in demand. And see, since it's a rate cut. It's a rate cut, guys. So we can have a safe assumption, guys, like the gold demand would be increasing, or the gold prices would be increasing in the coming days. Reason being, there is a negative relation between all of these, like the Fed rate cut, or what I would say the Fed rate and the gold prices. So this is how like we can have a safe investment decision in the upcoming days. Like for India, it's a good signal. Like the FFIs are coming due to this rate cut into India. They are pumping more and more money into Indian stocks, and although it's a festive season for India, and there is a huge what I would say demand for gold in India. So yeah, for the gold prices, which we can see that it would be setting a new record high in the coming months, we can say. And yeah, this is all the focus areas which we can derive out of it. And yeah, it's a brief gist which I can like to safely conclude, like what this FFR has a far ranging economic effect, starting from US, like the interbank borrowing rate, till a PLR, till the US like home loan borrowers, and even we as Indians, like how our financial market, our like decisions might be affected out of this. And there is a high chance, like in India also, the Monetary Policy Committee in the month of December, there is a high chance like in the month of December 2024, there might be a rate cut by Indian RBI also. But yeah, this being said, it's again judgmental and questionable, like how the situation, the economic situations changes with the coming of new, what I would say, outlook and frontiers in the coming days. So yeah, thanks for watching it, guys. We will come back with more interesting topics in the coming days. So stay tuned. Thank you.